Welcome to Finance Infopedia. For people who are new into equity market and people who are already buying stocks directly, but those who don't have any idea about how equity market functions or what all things they should look into while buying a stock, this video is for them. And in this video, I will be discussing regarding a financial ratio, and the name of the financial ratio is debt to equity ratio. In debt to equity ratio, there are two most important words. One is debt, the other one is equity. To explain about debt to equity ratio, let me tell you how a business raises its capital. For someone to start a business, first thing required is capital, right? To raise capital, there are two ways mainly. One is through debt, the other way is through equity. Debt, we all know. What is debt? Debt means we are taking money from someone or an institution or bank, and the money that we take, we have to repay it back, and along with the principal amount that we should repay back, we have to pay an interest over that principal amount. So this is what is called as debt. The second way of raising money to run a business, to raise capital, is equity. What is equity? Equity means ownership. Means if you are raising money from a person through equity, then you are taking some amount from that person and you are not going to repay that particular amount to him. Instead of that, you are giving a particular share or ownership of your company to that particular person. So debt to equity ratio is a ratio where you will compare the debt of a company with the equity of the company. So let me give you an example. Take the case of Britannia Industries Private Limited. Britannia Industries, if they want to raise capital, there are mainly two ways. One is through debt, the other way is through equity. For the sake of easy explanation, let's assume that the total capital raised by Britannia Industries is 2000 crores rupees. Okay, we should understand how they have raised this 2000 crore rupees. So when we try to understand, we realize that this is just an example. We realize that 1000 crores Britannia raised through debt. 1000 crores Britannia raised through debt. And the other 1000 crores Britannia raised through equity. So the first 1000 crores that the Britannia company has raised, they have to pay it back along with the interest. The other 1000 crores which the company has raised through equity, there is no need for them to pay it back, because for the 1000 crores they raised as equity, they have issued shares to the public and other institutional investors. From whoever they have raised that money, they have issued shares to them. So those people who gave that 1000 rupees as equity, for them they have received ownership in the company. Because of that, there is no need for the company to pay back the 1000 crores rupees raised as equity from outsiders. Now, so already we discussed, we told that 1000 crores is raised as debt and other 1000 rupees is raised as equity. Now in this case, let's see what is the debt to equity ratio of Britannia Industries. Total debt is 1000 crores. Total equity is 1000 crores. So the formula for debt to equity ratio is total debt divided by total equity. So as per the formula, it will be rupees 1000 crores, that is total debt, divided by rupees 1000 crores, that is total equity. So rupees 1000 crores divided by rupees 1000 crores, what will be the answer? The answer will be 1. So the debt to equity ratio of Britannia Industries as per our example is 1. In real case, as per the 2021-22 annual report, the debt to equity ratio of Britannia Industries is 0.97. When you get this debt to equity ratio as 1, what you should interpret from that? Means the company has taken debt as much as the company has equity with them. A company that is having a debt to equity ratio of 1 is in a higher riskier position when comparing with a company not having any debt or a company having a lesser amount of debt. So you cannot understand whether a company has taken huge debt or not on a standalone basis. Just because a company is having 100 crores debt, whereas other company is having 1000 crores debt. Again, just for example, Avanti Feeds, just assume that the company Avanti Feeds is having 100 crores debt, whereas Britannia is having, or HUL is having, or another blue chip company is having 1,000 crore debt. Just because a company is having a lesser amount of debt, that is 100 crores in the case of Avanti Feeds, comparing with Britannia or HUL who is having 1,000 crores, it does not mean that Avanti Feeds is in a better position. Whether the company has taken huge debt or not, you have to analyze it on a relative basis. You have to take the debt and compare it with the total equity of that business. That is where debt to equity ratio is very important. So a company having only 100 crores debt and the total equity of that company is 50 crores, then the ratio will be rupees 100 crores divided by rupees 50 crores, and the debt to equity ratio will be 2, which is a very very bad position. That means the company is in a very very bad position. The company has taken too much debt, more than what the company can manage. Whereas on the other side, another company has taken 1,000 crores debt, but the total equity of that company is 4,000 crores. That means 1,000 crore debt divided by 4,000 crore equity means the debt to equity ratio of that company is only 0.25. Means that company is in a much safer position comparing with the first company, even though on a standalone basis the debt of the second company is much higher than the first company. But when you compare that with the total equity of that particular company, you will realize that the debt to equity ratio of the second company is much better and safer than the debt to equity ratio of the first company. In this screen, I will show you how to find the debt equity ratio of a company. I will show you the example of screener.in. So in screener.in, I will show you how to see the debt equity ratio of a company. You have to create an account. Then after creating an account, you can add the debt equity ratio. Okay, you can add it like this. And once you search debt equity ratio, you will find this one. Click here and it will be added onto your accounts. Then afterwards, whatever companies that you search, you can see the debt equity ratio of that company very easily. So this is the way you need to understand debt equity ratio. This is the way to find the debt equity ratio of a company. So what I will suggest is, if you are investing in a company more than debt equity ratio of 1, then you are taking a huge risk, because if something happens, for example, the company starts reporting negative growth, or the company starts losing its profit because of high competition or something, and if the company is not able to repay back its debt with interest, then the company can go even into bankruptcy. In that case, the share price will collapse, and whatever money you have invested, you might end up losing everything. That does not mean that a company is having debt equity ratio of 1 or above is a bad company. I didn't mean to say that. Point is that if something goes wrong more than the expectation, then these companies are on a riskier position. The companies may not be able to pay back its debt, and for that reason, to be on the safer side, especially as an amateur investor, see, if you are looking other aspects of the company, there are many financial ratios, there are many things that you need to look into. So if you are a professional investor, or if you are very expert in that, even a company having high debt, if the other aspects of the company is very well, then you can definitely invest in a company with a debt equity ratio of 1 or above. But being an amateur investor, being a learning person, if you are starting to invest in equity right now, then it is always safe and better to stay away from investing in companies having debt to equity ratio of 1 or above. For me personally, I prefer to invest in companies having a debt to equity ratio of 0.5 or less. Blue chip companies like Nestle, HUL, Dabur and all, I believe that these companies are not having any debt, and because of that reason, their debt to equity ratio will be 0. The total debt will be 0, and total equity might be 1,000 crores, 100 crores, 1 lakh crores, 2 lakhs crores, whatever. So the ratio for these blue chips companies will be total debt divided by total equity, that is 0 divided by total equity, which will be 0. So the entire capital amount they have invested in the company, it is their own money. There won't be anything for them to pay back to the banks. So that's why their debt to equity ratio is 0. Understand that these blue chip companies also initially they raised a lot of debt. So raising debt is not a bad thing, but as the company became blue chip, as the company became more matured, they got into a stage where all the expansions of these companies, they are able to pay for their expansion activities using their own profit, using their own retained money. That's why they are in a position where they are able to run the business without taking any debt, and that's why their debt is 0, and that's why the debt equity ratio for those blue chip companies are 0. So always keep in mind that when you are investing in a company, first go and see the debt equity ratio of that company. It is safe and better if you avoid investing in companies with debt equity ratio of 1 or above. To be on the safer side, try to invest in companies with debt equity ratio less than 0.5. As you move forward, as you learn more and more, you can start taking little bit of risk by understanding the other aspects of the companies. If you feel that the company is very good even though the debt is very high, then you can start investing in companies having higher debt. But as a beginner, always stay away from companies having debt equity ratio of more than 1. To be on the safer side, as I said, invest in companies with debt equity ratio of less than 0.5. We will meet again in the next video. Thank you. Thanks a lot.